is about securities firm and investment banks in the United States, and also some of the venture capital. In aggregate, they are called financial investment services because their roles are somewhat duplicated and they share some of the competitive markets. But generally, they have some their own areas. So security firms, when I say they relatively focus on retail financial activities, while investment banks, they focus on the wholesale part. In other words, they engage with corporate customers, and the venture capitals, they are for startups and the venture companies. So in this chapter, I'm going to talk about the financial investment services overall in Korea, and then we are going to move on to each of these activities. So first, let me define a financial instrument. So by the way, the things that I'm going to say in this chapter is basically related to Korean legal system. So it may be different for the international students in your own country. So please note that. And financial instruments are assets, financial assets, and it contains some right, and the rights are about the future cash flows. And there are three certain things to be included in this instrument. First, it should promise certain returns in the future. So it is expected to earn profits under specific circumstances if we buy this financial instrument. And second, it is not guaranteed. So there are risks. So there is a potential possibility to lose your starting money. And third, they should be traded. So you can exit or you can enter this investment whenever you want. And if certain financial product has the three characteristics, then we can call it as a financial instrument. And the financial services or financial investment services are something related to providing and helping the traders or trades of the financial instruments. In the past, these concepts of financial instruments were not defined in Korea. But at the time, for example, in 20 years ago, we had several different areas of the securities. So we had securities brokerages, which are related to the securities firm, and we had futures and other derivatives brokers who are not the security firms, and we had funds, collective investments, we have trust provided by some banks, and these classifications is that although they are dealing with similar financial products, they are legally classified as different entities. So even if you are a security company, if you are authorized by Security Brokerages Act, then you cannot participate in the derivative market. You cannot provide the funds to the investors. So there was a barrier between these groups, and that was harming the efficiency of our financial markets. So it is difficult to develop new financial instrument because you need to provide some explanation in which area your new instrument belongs. If you argue that your new financial instrument is a securities, then it will be legally bounded according to the Securities Brokerage Act. but not the others. So it cannot be traded by the futures company, or it cannot be traded by the funds or other collective investments. And also, as I said, you cannot enter the new market, and that result in the consumers' difficulties. So it is very difficult to understand these complicated legal contexts, and it is very difficult to identify whether certain financial instrument is this one or that one, because ordinary people do not understand their differences. So therefore, consumers will not be protected, and it is possible that some bad financial institutions may fool these consumers, and they take their private interest. So as a result, there was a reform in Korea in 2009, which is called as Financial Investment Services and Capital Markets Act, and in short, it is called the Capital Markets Act. And this act, the aim of this act is to incorporate every financial instruments into a single umbrella, so that you will easily understand the financial instruments and the financial markets from the investor's perspective. So this is something related to the legal system. So let me talk about it briefly. So around the world, we have 3 or 4 branches of the legal system. So we have continental system, and we have English legal system, and they are totally different. So in this continental legal system, in this system, what is important is the separation of the court and the parliament. So when a certain thing should be, if some politicians agree that this should be our law, then they should pass it from the parliament, and when after it is passed by the congressman, then it will be act as a law. So, and on the other hand, in the English legal system, what more important is the what people behave. So even without a direct passage of the law from the Congress, the courts have their customs, and it will be adopted as a rule. So and that's one difference. And another difference is that generally in this continental legal system, the focus is to protect people. So generally what the law says is you should not do something. And you can do something. And so that in this continental legal system, when the new product or the services are developed, generally issued authorized by the government and the Congress, to make sure that it would not harm the citizens of this country. So it takes a long time for it to be adopted in the market. But on the other hand, in the English legal system, generally there are no specific some guidelines in the law. However, there are just brief principles, and therefore if it fits those principles, then the new products or services can be quickly adopted. But of course, there is a pros and the cons. So when the new products or services may enter easily. At the same time, it may bring some harm to the citizens. So it is less protective. However, it promotes some innovation. So it is quicker but and efficient. However, it may fail and it may result in some crisis. But in this system, it is more robust and it is more protective, but it is more at the same time it is more conservative. So Korea has a tradition of following the continental legal systems as in France or Germany, but nowadays one of the most successful economies are the United States and the United Kingdoms, which have the English legal systems. And some economists or some lawyers argue that the reason that the United States are so successful in their economy is because they have this tradition in their legal system, so it helps them to adopt innovation quickly than the rest of the countries. So therefore, we are trying to convert our legal system into this legal system, and this Capital Markets Act is one of the things that we have done to follow this legal system. So before the Capital Markets Act adoption, we had a restrictive prohibitive legislation, affirmative legislation, which means you security firm can do number 1, number 2, number 3, but not the others. So we allow something, but we prohibit everything else. But after the capital market, we changed. So we now say securities firm cannot do A, B, and C. However, you can do anything else. So it allows more actions, choices for the security firms. So it has some rooms for the development. And furthermore, before the enactment of this law, we had an entity-based regulation. It means which type is your financial institution determines your regulation. So if you are a securities firm, you should follow the Securities Act. If you are a futures company, you should follow the Futures Act. If you are a funds, you should follow Funds Act. So it depends totally what is you. However, this may result in some problem because nowadays the financial markets are incorporated and there are very, very similar activities among different entities. So it is better to regulate these entities not based by their types, but based on what they do. So if you deal with the securities, you should follow this. Or if you deal with the funds, you should follow this. That will be more efficient and that will be more easy to understand. So that's the activity-based regulation. And by changing this, and we wanted to enhance the consumer protection so that financial consumers, the investors, can easily understand the legal context and they can easily buy and sell the financial instruments under the protection of the government. And now we classify the financial services based on what they do. So there are several categories about the actions that the financial institutions can do, such as investment dealing, brokerage, funds, trust, and advisory activities. And securities firms generally can participate in any of these services nowadays. So this is removing the barriers in the capital market. And then let me talk about the securities firm, especially in Korea. So a securities firm, this is a financial institution, and it is not limited to, but it provides these services. First, brokerage services, dealing services, underwriting, And these are the three major activities. Here, underwriting, I'm going to talk about the underwriting when I talk about the investment banks, because they focus on the underwriting activities more. And let me talk about the brokerages and dealings here in this part. So if we look at the capital markets or the financial markets, we can classify any of the market. So here the term market means it is not a physical location. It is a conceptual location where some people are trading. Some people are having some transactions, and that can be the capital markets. So if you trade, if you buy or sell your financial instruments, then this is your capital market. And there can be a lot of financial markets, but generally we can classify them into two groups. First, there is a primary market, which is the initial issuance of the financial instrument. And in this market, corporations are the governments are the users of the funds, and the suppliers of the funds, the investors, they participate in this trade. So investors give the money to the corporations or the government, and by using the money, and in return they get the securities. So this is called as a primary market because this should happen first. But at the same time, we have a secondary market, which is in which investors themselves trade among them. So some investors feel they want to exit market while others want to enter. In that case, they can have a deal. So investor A gives the securities to investor B, and in return, investor B gives the money to investor A. This is called as a secondary market because it can happen to exist after there is an initial issuance. So this is a secondary market. And when we talk about the activities of the securities firm, the first primary market is more related to the underwriting activities, while the second market is related to the brokerages and dealing. So what is the difference then between the brokerages and dealing? When I say brokerage, this is trading financial instruments but upon the customer's request. So a customer comes to the security firm and he says, I want to buy a share. And the security firm may help the customer by suggesting or recommending a share from the market. And that will be called as a brokerage. On the other hand, dealing is the transactions by the securities firms themselves. So the securities firms seeking profit, they also buy and sell the securities from the market, and that will be called as dealing. So brokerage is for the customers, and ultimately there is no risk because they asked it for, so you are just following their request, and you are going to get some fees providing your services. On the other hand, dealing is high risk because you are buying and selling the shares and the bonds. So therefore, sometimes you get the profits, but sometimes you lose your money. So therefore, it is imaginable that in many cases, many securities firms will try to engage brokerage because it is easy money, while dealing is difficult. So, and this is true. So let me show you. So this is a brokerage fees from the United States, America, and before 1980s, the portion of the brokerage fee took about a majority of the profits by the securities firm. So at that time, what securities firm do, most of the activities were classified as brokerages. However, now thanks to the development of the capital markets and thanks to the adoption of the new technologies, it became more and more easier for investors to directly participate in the financial market. So, for example, in the 1980s, if you want to buy a share, what you have to do is to call a phone call to a security firm in Wall Street, and you should request to buy certain shares from the market. And you don't have any information about the performance of the companies. You don't know the stock prices. You just request it, and the brokerage firms, they will provide you information upon your request. So that at the time, that was very difficult for individual investors to directly participate in the market. So the fee charges, the security firm charged a lot of premium for their transactions and services. But later, now we have a NASDAQ and we have a computer and internet. So therefore, we now experience a such called home trading system, which means if you turn on your personal computer, you can access the network and you can buy and sell the stock there. So the helps from the security firms, it is not that important anymore. You can just do it by yourself. And furthermore, after the introduction of the iPhone, now we have a mobile trading system, and you can do it. You can participate in a financial market even if you are traveling, right? So you don't, nowadays, the roles and the importances of these security firms are becoming lower and lower, and there are more competitors. So therefore, the profits they get from these brokerages activities, it is decreasing. And naturally, they are trying to convert their interest into other activities such as dealing as well as the underwritings that I'm going to talk on Wednesday. And by the way, because security firms, the major activities, those three activities are relying on the financial market, so therefore their overall profit may fluctuate depending on the overall market performance. And you can see that generally the performance is upward trending. However, in 2008, they had the global financial crisis. So at that time, many securities firms incurred losses, right? Okay, and because we have time, let me explain the process on the brokerage. There are two types of your request. The request in the stock markets are called orders because it is similar to ordering something in a restaurant. So there are two types. First, we have a limit order. This limit order is specifying the price that you want to trade. However, there is another option as an investor that you can have a market order, and this market order is a request but without specified price. You just totally rely on the market price for your transactions. So it is adapting to others' decisions, while limit order, this is about having your strict rule or more strict rule about how you think about the prices. So the advantages of the limit order is that you fix the price, so you get what you wanted, but it may take longer because you should wait that there is a counterparty who wants to trade in this activity at the same price. So if you are a buyer, you should find out the seller who agrees with you that the price should be this one. Otherwise, your buying transactions will not be completed because there is no one trying to sell that. On the other hand, when you order a market order, then it is faster because you don't wait for your specified prices, but you just adapt to others' orders. If there is a seller demanding $100, then you just give it and you get the share. So it is quick, it is more rapid transactions. However, there is a possibility that you may result in something which is dramatically different from what you imagine. Maybe you imagine that the stock price should be about 100, but eventually you buy that share at $200. This is possible. So let's say we have a company called Circuit City, and there are some and you are a security firm, and there are some orders from your investors. And there are, first, some investor wants to buy 300 shares of Circuit City at market price. Second, another investor wants to buy 100 shares at specified price. So this is the limit order. And there is another transaction requested selling 400 shares at 37.40 cents. And let me step by step show you what happens. By the way, this is the initial status. So this is often called as order book. So this is a recording about people's demands and the supply. So here the price, this is the highest price, this is the lowest price, and here it is the number of requests who wants to sell the shares, and this is the request to buy the shares. And you can see that selling orders are only on the upper side because no one like to sell at lower prices. Similarly, buying orders are only at the here on the bottom, not here on the upper side, because everyone wants to buy at lower prices, right? And then there are, in aggregate, there are 800 orders, and there are 500 orders, but they are not completed yet because there is a disagreement about the stock prices. The sellers, at minimum, they want to sell it at 37.4. However, there is no one to buy at that price. So at this moment, there is no transaction. They have only disagreement. And that is the current status. And now we see that there is a first order. That one investor wants to buy 300 shares at market. And this is a market order. So for the investor, the security firms will match this request with the best options available at this current status of the order book, which is $37.4 and 200 shares. And therefore, because the investor wants 300 shares, but there are only 200 shares, so there is a two-step. First, the first 200 shares will be traded at this price, and the remaining 100 shares will be traded at a relatively higher price. And the result is this one. So here we had 200 shares before, but now it's gone because it was matched to that investor and it was completed. But the remaining 100 shares here should be traded at a higher prices. So it was 500, but now is 500 minus 100, so it is 400. And investors will observe that the latest transactions was made at the price of $37.5. And also we see that there is a spread becoming higher. So before this transaction, the spread, this is often called as bid and the ask spread. So the spread, the disagreement, disparity between the selling prices and the buying prices was only 10 cents. However, after completing the first order, now the spread have widened, so it is 20 cents because some of the transactions were made and the remaining orders are decreasing. And then the second order, buying 100 shares at 37.4. So this is a limit order. So they go to the order book and there is nothing yet. And there is nothing yet. So this cannot be matched. So therefore, the security firm just write down the order into here. And what you see is that 37.4 we have new 100 shares to be bought. But no transaction was made at this moment because it was not matched to the counterparty. So still the latest transaction is from the first investor who traded at $37.5. And finally, we have another order selling 400 shares at 37.4. And then if you go back to the current order book, there are 100 shares to be bought and we are wanting to sell 400 shares. So initial 100 shares would be matched here. However, this order is also a limit order, so it does not change the price even if it is not completed. So the remaining 300 shares are still here. So the final order book will be recorded like this. So the selling orders, the lowest price is 37.4 and there are 300 orders. And the buying prices at maximum is 37.3, but this is not matching each other, so they are just remaining in the market. And the latest transaction was made at the $37.4 per share. So this will be shown to the investor as a valuable information. So in this example, this illustrates the process in the transactions of the shares. So you should remember that in the market, in the financial markets, you just look at your monitor or your smartphone display. However, this is not the end. In the opposite side, you should remember that in the opposite side, there should be a counterparty who are having a similar opinions with you, and then you can have a transactions. On the other hand, you will not be able to trade your securities.